Broadcast is now starting. All attendees are in listen-only mode.
There we go. All right. Good afternoon, everybody. My name is Bobby Rains. I'm here for our regular once every 3 weeks members only Investors Observer members only workshop. Yeah, let's get started. So I got kind of a different agenda this time through a little bit. I kind of wanted to move some things around, do some things differently, integrate the questions that we got ahead of time with some of the market commentary a little bit better. So doing that. As always, just if you have questions at any point, just submit them in the box. I've got two giant screens here and one has the question box open. So if you put a question in, I see it show up, and if it's relevant to what I'm talking about in the moment, I'll try to get to it. Otherwise, we'll go through a bunch of questions at the end. Thank you to everybody who submitted questions ahead of time. You can submit questions ahead of time anytime you want. Just just mention workshop, or what a lot of people do is when they get that first invitation, just reply to it and say, hey, here's my question. Either one of those works. All right, so this our agenda for today is, all right, I always leave what's going on Investors Observer up here. We don't have a lot of exciting product things to announce. We're working on some stuff. We have some big announcements that are coming hopefully later this summer, but I'm not going to get into those details today, but stay tuned for that. And then, we always are working on other things as well. All right, so we're going to look at a bunch of charts that will hopefully explain what's happening in the market. Look at SPACs using CCIV, which is Churchill Capital 4 as an example. Some market and economic commentary, and then it's into the member-driven content, questions, site demonstrations, etc. So with that, let's go look at some charts. All right, so this is the last year of the S&P 500 with 50, 100, and 200-day moving averages. I think the only difference between this and what we usually do is I got rid of the candlesticks because it just seemed kind of distracting, and looking at 220 candlesticks is not super useful. So the thing that I think is interesting here is as you start to get further away from the 200-day moving average, which happened here and here and here, things tend to get less exuberant the further away you get from there, let's say. So it's kind of normal to see a pause when you get here. And this were about the same distance away in percentage terms. I think it was a little over 15, 16%, something like that. So it's the kind of thing to keep an eye on. It doesn't necessarily mean we're going to have any sort of, big or less big pullback here. It just means that, things don't necessarily just drift away from that 200-day moving average forever. All right, so I've got kind of a theme going here, but first let's just get into what we're looking at. All right, so this is the S&P 500 in white versus the S&P 500 equal weight index in blue for the year of 2020. Okay, so obviously you have the pandemic starts and then the whole recovery. That's that. And so the S&P 500 is market cap weighted. So Apple, Google, right, the biggest companies have more sway in how the white line moves here than how the blue line moves. Okay, so if it's just those 5 big companies going up, you'll see the white line go up more than the blue line goes up, which is what we saw for most of 2020. All right, so as we get into 21, and I just use the year end and year start dates, it may have made more sense to try to draw the line somewhere around maybe November when the first vaccine was approved, because there starts to be a difference there, but for our purposes, this is fine. So in 2021, what we see is the equal weight has outperformed the the cap weighted index. What this means is, essentially companies 5 through, or 6 or 7 maybe through 500 are doing better than the top 5, which is, that's what this is. This is the companies at the top doing well and everybody else doing less well. This is, sort of everybody participating with maybe that top group participating a little less. Okay, so this is, again, though, for the 500 largest publicly traded companies in the U.S. So it's not necessarily a representative sample of the whole market, although it is a good proxy for sort of how the market is going. So if you want to look at a broader index, here's the Russell 2000 ETFs that Vanguard has that split along growth and value lines. So growth is going to be technology, right? Things that are growing fast, whereas value is going to be, things where the price makes a little more sense in terms of the growth of the company, but it's going to be your stodgier, real economy sort of things, as opposed to a lot of tech and healthcare stocks, which tend to be a lot of times in the growth sector. And so you can see here again for 2020, growth just, growth absolutely blew value out of the water, right? Value gained 5% for the year. Growth gained 35% for the year in 2020. So 2021 year to date, that has totally turned over. Growth is at about a 5% gain so far this year, and value is up for a little more than 20%. So this is a big rotation that has happened recently, and we've published a bunch of articles recently, but we're getting a lot of questions where people ask, some version of the question like, when will the market correction stop? And I look at the market and we set, this week I think we only set one new high, or maybe that was Friday. It's been about 4 days since the S&P 500 set a new high. We set several last week and several the week before. But I think a lot of people got into chasing these things that were up a lot over the past year and maybe are just not exposed to the broader market in a way that would let them see that, this is actually the story here. So we'll talk a little bit about how investors can follow this in a couple minutes. All right, so another thing that's happened recently is volatility is way down. So this is 2 years of the VIX. So from about April of 2019 through all of 2020 into this year, right? Obviously the pandemic comes along, and this is a 28-day moving average just to give you a little bit of a smoother line to look at. Which gets important, especially here, because it spiked a little bit this week at the end of last week, but the trend is still definitely just lower. And so the VIX, essentially, by taking option prices into consideration, is a proxy for what traders expect the volatility of the S&P 500 to be over the next 30 or so days. And so obviously those expectations have gone way down. Which is not surprising, right? Like, things are reopening, the political situation seems more stable. There's just a lot fewer crazy things happening in the world, so there's less reason for option prices to be high. I mean, even, you can see this spike here and then some of this a little bit later, right? This is GameStop mania, let's call it. All those people buying cheap out of the money options and then the stock jumping way up. Well, the people who price options are going to raise the price of options for that. It's like any other insurance contract. If there's some unforeseen risk happens, the price of insurance goes up until everybody can kind of figure out what's going on again. So that's what happens here is, even though the market wasn't going down at this point, right, the GameStop mania shows up in the price of options. So another way to look at volatility is to look at the volatility of the volatility index. I know this is a little nerdy, but it's also pretty low. It's the lowest it's been since pre-pandemic, which is not surprising, a good sign, a sign that we're getting back to where things, where we would hope and where we would like things to be. So this is all generally a positive for investors, right? It makes the market a little bit more boring, but after the last year or so we've been through in the market, I'm kind of okay with that. Especially because, like I said, we're record highs. Things keep going up, and there's lots of reasons to be optimistic. All right, so the big third sort of point I'm trying to make with all of this is there's been a rotation from 2020 into 2021. Like I said, the turn of the year is a little bit of an arbitrary selection on my part, but it's convenient. The chart tool makes it real easy to chop it off at the turn of the year, and it's close enough for these purposes. All right, so it's really what I'm calling a rotation from story to stuff. So 2020 and early 2021 even were all about what we'll call story stocks, okay? So the pandemic stocks that had a good story, and a lot of them had the growth to back it up, right? Think about your Peloton and your Netflix and your Zoom, a bunch of those things that were relatively smaller, but I mean, to some extent also, right? Like Apple and Microsoft and Google, all those companies were in a position to either take advantage of changing consumer behavior because people were stuck at home and doing a lot more things online, or take advantage of sort of the changing work environment, which is lots more people working from home. And so there was some story there, but there was a lot of growth. Zoom added a hell of a lot of customers in 2020. Netflix added a lot too. Now Netflix reported earnings yesterday, and their subscriber adds were less than expected, and a lot of that is probably just because, right, sort of things got pulled forward. A lot of people signed up in 2020 that maybe would have signed up in 2021 under other circumstances. So that's happening. Electric cars were another big story in 2020, right? Like things started moving. Tesla hit profitability. We had a bunch of other electric car companies come online. It looks like electric cars are, I've been promised this, I feel like, my whole life. But it looks like electric cars might actually be a thing at some point pretty soon. The story was, like one of these companies, Tesla, could be the next company at a scale of a General Motors or a Toyota or something like that. Obviously, if you can get in on that investment and, the next General Motors before they sell the first car, the growth potential there is incredible. Even GameStop was a story stock, right? Like fundamentally, it got crazy and turned into just gambling, but the original rally was sparked by a bunch of people, I guess maybe just one guy, but some people who agreed that if this company can do something in terms of changing their business, then a higher price makes sense. They have some brand value, et cetera, things like that. It's a story, basically, right? I'm not saying there's not some good reasoning behind it, but it is a story that you're investing in. You're not investing in GameStop, the company that has stores at the mall that sells video games in boxes, because that business's trajectory isn't up. You're investing in the story that there's some change that can happen to send this higher. All right, but with vaccinations, we're looking at a potential end to the pandemic. That really sort of changes the narrative. I feel like I've said this a couple presentations in a row now, but who is signing up for Zoom 6 months from now that doesn't already have a Zoom account? I mean, there may be a couple people, right? But it's not a lot, right? There's a huge, right? Zoom added a ton of customers, and there's not really that many customers for them to add right now. Just, you'll get some new businesses forming as the economy grows and things like that, but the big jump in terms of growth has happened for now. But also lots of people have extra money and they're looking for a place to spend it. Like I'm, still working from home, not going a lot of places, things like that. It might be nice to just go do some stuff and drop some cash some places. Lots of people are in that situation. There were lots of people on the other side that are desperate to get back to work because they haven't been working for the past year. I understand that, but lots of people also have extra money to spend and are looking for a place to spend it. And some of the other stories have changed too. General Motors and Toyota have pretty aggressive electric car plans. Toyota's has plans to, I don't remember how many models they plan to make by 2025, I think, and they're going to start selling some, later this year. The story for those, small startup electric car stocks is very different in an industry with big established players, right? Tesla managed to successfully launch the first new automobile brand in the United States for quite a while, but they were able to do it because they had something that was different, right? If you wanted an electric car, it was Tesla or kind of nobody. Once GM and Toyota get into that game, all the other electric car companies, it's a lot harder to stand out. So the story changes there. And yeah, people have other things to do. The pandemic pushed a ton of people into markets. It shut off sports. All kinds of things happened, roughly this time last year. And yeah, that combination of boredom and stimulus checks and, Robinhood and some other new trading apps, plus lots of people with money to burn, led to all kinds of crazy stuff happening, right? Like, I don't know if anybody remembers, Hertz went bankrupt and then rallied because everybody wanted to buy. Yeah, I still don't necessarily understand that one exactly. And then later, yeah, GM, GameStop, and the AMC, that kind of weird Reddit Wall Street Bets rally. That's people with money and free time on their hands looking for something to do more than it is any sort of repeatable thing that is tradable. And so, hopefully there's also lots of new investors in the market. And these are people who are looking for a longer term payoff. So when I say investor and trader, I really mean sort of two different groups of people, or at least two different activities. Okay, so investing is having a long-term outlook, trying to make money over the long term through the power of compound interest to a large degree. Okay, so you're looking at smaller gains on any given day, but also typically smaller losses. Okay, so you're a lot less worried about daily market moves and more concerned with trying to put money in position to benefit from economic growth cycles. Okay, so traders tend to have a short-term focus, trying to buy things when they're moving and then get out before they stop moving or roll over. You have big gains and big losses, and it's very much about what's happening today. There are traders who don't like to leave, go to cash on Friday afternoon. You don't know what might happen over the weekend. Take it all out, right? Like, trade in the morning and then go play golf in the afternoon kind of a thing, but right, close those positions before you go, because right, that's the kind of position you have is one you don't want to step away from your computer. That's closer to trading. And then yeah, don't really care about the economy because I just want to put money where the action is. All right, so then and some more thoughts are investors are buying companies and cash flows. Okay, right, so this is a company, it has a business, it does a thing, it makes money, or has a clear path to profitability. You're staying away from stories unless there is a clear path from the story to the profitability. And yeah, the Warren Buffett quote about be greedy when others are fearful, that's an investing kind of thing, right? Like, oh, the market's down, I have a long time horizon, I can buy things now while they're cheap because I expect it'll go back up over some amount of time. Okay, this is a whole portfolio strategy, or a large chunk of your portfolio strategy. Whereas traders are, again, buying what's moving, right? I don't care about the story, valuation, profitability, that's the next person's problem, right? Like, nobody who bought Hertz after it declared bankruptcy had some, right, like, cogent thesis about why that was a good idea. It's just, here's a stock that's going up, I don't know how it started, whatever. But yeah, that's a trade. That's not an investment. And instead of be greedy when others are fearful, traders are very much operating on the greater fool theory, which is it's fine to buy whatever at whatever price as long as you can sell it to somebody who's a greater fool at some point in the future at a higher price. And this is not a whole portfolio strategy. I've known people who were professional or semi-professional traders, and they managed a relatively small number of positions with a relatively small amount of their account, and the rest of it was in something that was super low risk. Okay, so you have some amount of money in a portfolio, and you have some amount of risk you're comfortable with. And the ways to do that are you could either, if you're at a moderate risk level, you could put your whole portfolio into things that are moderately risky, or you could put some things into strategies that are super high risk and a bunch of other things into things that are very low risk, and you sort of average out to moderate riskiness. But yeah, it's not a whole portfolio strategy. If you have your whole portfolio in short-term things, that's very dangerous and not, certainly not, sort of investing. All right, so let's talk about Churchill Capital 4, which is a SPAC or special purpose acquisition company. They have a deal right now to merge with Lucid Motors, which is one of these electric car companies. We can talk about that in a minute. So they went public back late summer, early fall of last year at $10 a share. Almost every SPAC IPO is at $10 per share. And so you get, in the IPO, you get shares of stock and usually some warrants to buy stock at another price in the future. But we'll just say $10 per share. So they raised $2.7 billion, a little over $1 billion. Okay, so the stock just trades along at about $10 a share for a long time, right? And that makes sense because at this point, it's a company that has, its assets are basically a bank account that has $10 for every share outstanding, or roughly $10 for every share outstanding. The people who sponsor the SPAC end up getting some shares kind of for free. So it's your $10 is actually worth a little bit less than $10, but whatever. For our purposes, we'll call it $10 a share. So it makes sense for the stock to trade like this at about $10 a share because literally what you own is $10 in a bank account somewhere. Perfect. This is totally rational, makes sense. Hang on just a second. I dropped my mouse. There we go. Okay, so then on January 11th, Bloomberg reports that the SPAC is looking to merge with Lucid Motors, an electric car company that's then private. And the stock just goes nuts. Okay, and this might make some sense also. Okay, because electric car stocks have at this point pretty high valuations. It's an exciting thing. This could be great, but remember, it's still $10. Okay, so it goes up and up and up. At one point, it almost got to $65. So you have a bank account that has $10 for every share, but interest in that bank account is trading at $65 per share. So what this means is the people who are running the SPAC have to go to this company and say, yeah, we know we only have $10 per share to give you, but the people who own these shares are actually expecting to get $65 worth of value for that. That it doesn't make sense, right? That's why it dropped off the table, because once the merger is announced on February, basically about the point where it drops off the table, February 22nd, at this point you've fixed the value to the shares. Okay, we've said, all right, we're going public. Here's what the value of the company is. Here's what the share count is. You can figure out exactly how much dollar value of the company each share is worth. And it dropped and has continued to just sort of bleed. This was yesterday's price. And so it's still $10. And right, what happens now is now you have the stock represents about twice the value, right? Presumably the people running Lucid weren't going to sell their company at a valuation that they didn't believe in. They were going to say, yeah, sure, come on in. We'll give it to you for twice what we think it's worth, which is where $20 would be, right? $10 a share, twice what it's worth, means you get $20 for the company for $10. Presumably the company didn't do that. So this still is a higher thing. Maybe investors are putting a roughly 2x the valuation multiple on it as opposed to the 6.5 it was at before the deal happened. But this is what happens with these SPACs, and this is why they can be so risky, is people bid basically a $10 bill up to $65. It doesn't make any sense, and it never made any sense. And I can't really explain exactly what the psychology is that made that happen, other than probably just a lot of people who didn't understand what was going on, and also a lot of people who just wanted to get in and buy the stock here and sell it somewhere like this, and weren't really worried about what happened over here because they were trying to get out before it fell off the cliff. All right, so before we get to questions, I want to talk about how to use Investors Observer to follow some of these rotations we're talking about. So we have these pre-built screens here, and there are some that go to specific sectors and industries. There's one for SPACs. There's one for momentum. So, as things start to get hot in the market, momentum certainly is a thing that comes in. So you see here, we got very bullish market sentiment. Short-term technical scores are very high. These are stocks that have been going up recently. Okay, so that's one way you can kind of find momentum, is look for what's going up. Other ways to do it are to look at our sector and industry tool. So you can find which sectors and industries. It's sectors on the left, industries on the right. And the way this works is the whole market is divided into 11 sectors, and those sectors are subdivided into roughly 146 different industries. So you can look and see, what's the best valuations are things right now like financial services, lumber and wood products. Okay, it's not super surprising, but if you want to look at, say, okay, so shell companies, which is your SPACs, it's 141 out of 146 in terms of valuation. Also 145 out of 146 in terms of long-term technical. Okay, that just been absolutely smashed recently. CCIV is not the only one that has fallen off a cliff like that. So we only show you the top few here. You can click on, if you see a sector you like, you can click in and see the top industries here. If you want to see more like that. But yeah, having a list of 146 things is only slightly more useful than having no list. So we have 10, but if there's a keyword you want to search for in the name of an industry, such as like Shell for shell companies, you can throw that in there. All right, so this is another good way to find those sector rotations in terms of, you can see, all right, here's what's hot this week, basically, with sentiment. Short-term technical will give you sort of what's hot this month or so. Long-term technical has a view, 3 to 6 months, let's call it, in terms of what's been hot over that period. And then the fundamental analyst rankings, like what do analysts like right now? They're still really into the SPACs for some reason. But yeah, you can also see, real estate, conglomerates, and things like that. So this is another great way to find the the sort of sector rotation. If you're interested in making some of those shorter term trades, you want to keep an eye on this and watch when things, if you're all in on a certain sector or industry, when that starts to fade, you want to find what's next, keep track of what's going up and down here, and you can do it that way. All right, so let's go back to the slides here. We got some questions. Yeah, instead of doing a bunch of economic commentary, I kind of wrapped most of the hot stuff into a couple of questions that we got here. All right, so what effect will inflation have on stocks? So this question and the ones on the next slide came from Kevork. So I feel like I say this every time, but I'm going to start by arguing with the premise of the question. You're sort of presupposing that inflation is definitely coming, which I know people are talking about it, but I don't think it's guaranteed. There's nothing in the data that really suggests it's happening yet. All right, so this is 12 months percent change in the consumer price index. So for all items, okay, so this is up to, I forget where this is, it's 2.6 or 7%. okay, which is roughly where it was. So that means that over the last 12 months, prices have gone up by about that much. Now, a year ago, prices went up basically nowhere. So if we were on the trend from sort of pre-pandemic with this spike, we'd still be below where we were before if the pre-pandemic trend had continued. Okay, so this is a steep line, but it's a rate of a rate, and it's coming off a very low base, so that's why that is. But I guess my thing is, if you weren't worried about inflation in 2019 or 2017, when these numbers were actually higher, I'm not sure why I'd worry about it now. And then if you want to dig in even further, so this is with food and energy taken out. So food, right, oil is, I think everybody knows, a pretty volatile commodity. And the CPI numbers for March in particular, they had stuff like that ice storm in Texas that shut down a lot of natural gas and oil production. And also, right, it was cold everywhere, caused natural gas prices to spike. It's hard to move some other commodities around. So if you take out the food and energy piece of this, inflation's still pretty low, and definitely a lot lower than where it was sort of pre-pandemic. And so the other thing to look at is eventually, right, if the prices for things are going to keep going up, right, if you're selling something and the prices for things keep going up, your customers are going to run out of money unless they're also getting raises, right? And so the other thing to look at in terms of inflation is the wage growth tracker. And so this one is from the Atlanta Fed. The other two are from the Bureau of Labor Statistics, which is what keeps the keeper of the CPI. And yeah, so there are some places where wages are growing a little bit. It turns out it's the service industry where there was just no work all year, and people are trying to, get more money as they come back to work. But yeah, wage growth is also still pretty low. So I'm just, I know people are talking about inflation a lot on TV, but I'm not seeing it in any of the data I'm looking at in any way that makes me worry about it. So with all that said, let's get into the rest of these questions. So if and when the Fed starts raising interest rates because they're trying to tamp down inflation, those two items, higher interest rates and inflation, will adversely affect the stock values and the markets in general. And will we be in bear territory, and should you consider put options? So if you think about inflation as essentially a decrease in the value of money, which, okay, value tends to be a rate, right? So it's dollars per unit of whatever. So either your whatever gets more valuable, means you have to pay more dollars for it, or your dollar gets less valuable, and so you need more of them to buy the whatever. This pushes the prices, right, the absolute number of dollars per unit, higher. It seems entirely possible that stock prices would just go up in line with inflation because stock prices are prices also, right? In fact, lots of people have claimed for years that the Fed is increasing or inflating asset prices with loose monetary policy. So I'm not sure that inflation by itself is necessarily bad for stocks, right? Like stocks are, right, when people talk about stocks going up or down, what they're talking about is the price. It seems to me like inflation should push stock prices up also. So the Fed's first level in terms of fighting inflation is to stop buying bonds. So after it stops buying bonds, it might raise interest rates after that. Either of those could be considered sort of monetary tightening. Tighter money should translate to sort of lower valuation multiples for stocks. And the way that works is if you think about a high stock price, means that if a company wants to go out and raise money on the equity market, every share they issue dilutes the existing shareholders. And so if you want to raise $1, the fewer shares you can sell to raise $1, the less dilution you have. So if you have a very high stock price, you don't need to issue a ton of shares to raise the amount of money you're looking for. The dilution is less. If the prices are lower, the dilution of existing shareholders is less. So essentially, raising equity capital is cheap when stock prices are high. So tighter monetary policy means raising equity capital actually gets more expensive because existing shareholders get diluted more per dollar raised. Okay, that said, there's no real reason for stocks to crash if valuation multiples come down. Multiples are also a rate, okay? So you got prices divided by earnings or something like that. Okay, so lower prices or higher earnings can get you those lower multiples. So if the Fed is tightening because the economy is too hot, right, which is what we're talking about, the economy is just going gangbusters and there's inflation because you got a ton of money chasing not enough stuff, earnings are likely to be pretty high, right? Think about the problem of, you have a line out the door and you just can't sell all the stuff that you have. You can raise prices. You have a ton of pricing power at that point. Earnings are going to be high. And so it's entirely possible that multiples can come down because earnings went up and prices didn't go up necessarily in comparison. So I'm not super worried about this. And then, finally, a bear market is a drop of 20% or more from a high. It's not impossible, but this whole Fed inflation thing doesn't seem to be the likely cause of a bear market anytime super soon. Single stock bear markets aren't really a useful metric, right? Like a 20%, 20% drop in a stock, I don't think is a useful or meaningful metric necessarily. It's more useful market-wide. But I do think it's worth noting that, we looked at those Russell 2000 charts. Lots of the 2020, early 2021 high flyers are down 20% or more from their highs. So at least some of the real fuel for a bear market in terms of the things that would sell off super hard, right? Some of those prices have already come down. And then in terms of buying puts are basically insurance, right? So if you can get puts relatively cheaply and it helps you sleep at night, fine. But you don't buy insurance for things that you're relatively certain are going to happen, right? Like if you have a dead tree outside your house, you take care of the tree. You don't just re-up your homeowner's insurance. If you're super worried about global warming and hurricanes, you don't buy beachfront property and put a bunch of insurance on it. You live inland. Or take some other steps to minimize the risk. So I think if you're super worried about some sort of bear market or correction because of this, what you do probably is position your portfolio in such a way that you're less exposed to this. I don't know that buying puts necessarily is the proper strategy there. All right, so on a scale of 1 very remote to 10 very probable, what is your opinion of a market correction and why? So again, this is a question of time frames, right? Like on a long enough timeline, it's a 10, right? Like on a long enough timeline, market correction is going to happen. If you're talking about the next 6 or 12 months, probably somewhere less than a 5. The economic recovery in the US is looking good. Vaccination programs are going well. Cases are falling. There is, as I talked about earlier, tons of pent-up demand and people with money to spend. Unemployment is still higher than I'd like, but that is likely to serve as an inflation buffer, right? We looked at that wage price thing, and if you think about wages as a price in a market, right? You've heard the term labor market. You have a bunch of extra labor supply in terms of all those unemployed people. Prices aren't necessarily going to go up super fast because, and by prices I mean prices for labor, because there's a lot of supply. So as demand ramps up and it sucks up some of that supply, we should see some wages rise. But it took a very long time after 2008 to get wages moving much higher. And unemployment got way lower than people expected. And so, yeah, I'm not super worried about it from that side of things either. And so, yeah, for some definition of overvalued or undervalued, the screener can be a good place to look. Let's go back to there. Okay, so we have a couple of different scores you can use. You can use first of all, you could just use the PEG ratio. Let's do a start over. So PEG ratio is a price to earnings ratio divided by a growth rate, where something around 1 is generally considered to be fair value. So no PEG ratio typically means the company either doesn't have positive earnings or there's something else going wrong with the data, and so you can't do it. Okay, so Boeing's kind of a weird case, but yeah, some of these, right? So a very high PEG ratio is going to be something that is probably not a good value, but you can also look at, well, we have a valuation score where a high score is going to be a good value. Okay, so IBM, so if you look at these relatively high valuation scores, you can see PEG ratios tend to be relatively low compared to some of the things we were looking at a few minutes ago. The other thing you can look at is the fundamental score, which combines some valuation metrics with what analysts think about the stock. And so analysts are a little better to maybe adjust their ratings for what they feel like the growth rate should be in the future, as opposed to the PEG ratio, which is backward looking. So those are both good ways to find stocks that are over or undervalued. And then, yeah, how to better use the IO system. We've talked about a couple, right? Finding things that are rotating, using the stock screener. We've got a lot of different tools and a lot of different scores because we're really trying to help people do a lot of different things. And so the best way to use the system really depends on what it is you're trying to do. All right, so a couple more individual stock questions. Square shows a bad fundamental under analysis, but most other analysts have a higher target price. So let's look at Square real quick, and then we'll come back and talk about some of these. All right, so yeah, that's not great. So yeah, this is an average of a bunch of analysts' target price. I don't know what target price in particular the question asker was looking at, but yeah, I looked at some other averages of target prices, and there's some that are a little higher and some a little lower, so it really just depends on which analysts are included in the survey. All right, so here's the other thing that I want to point out, though, about Square and valuation. Square was at about 50 a year ago and is almost 250 now. So that's a roughly 5 times increase. It's maybe a little tough to justify a 500% increase in the stock. Especially, and I looked here, sales are up a little less than 400% over the last 5 years, which is incredible growth. Don't get me wrong, but if you're up 500% over the last 12 months, you're not buying the stock because of some, Warren Buffett, Ben Graham deep value analysis. Okay, that's not why you're buying it. Again, there's a story there, but I have some questions about the story as well, because the company is absolutely in a fast-growing industry, right? Online payments, all that stuff is huge. But it's got a ton of very well-capitalized competitors, right? I mean, every bank has some sort of payment thing. There's also Stripe and PayPal and several other things that are out there that help people process payments. I don't necessarily know. I know Square's a big name and they got to market pretty early and they have some amount of market share, but existing market share doesn't necessarily mean growth in the future. So yeah, I don't necessarily think that the Square is a value stock at this point, so I don't necessarily disagree with our analysis there. All right, thoughts on CLNE, clean energy, after it tumbled. So clean energy is interesting. It seems they've gotten up caught in the frenzy around electric cars and alternative fuel vehicles. But the company description, and these typically come from company documents, says that it is a marketer and retailer of natural gas. And it buys natural gas from local utilities, does some stuff to it, and then resells it. So that means the price of natural gas goes up, this company has to pay more for inputs, okay? Now also it's selling natural gas that it buys from utilities. So it doesn't have some great source of carbon neutral natural gas. So in terms of the clean vehicle thing, we can talk about whether or not natural gas is cleaner than diesel. But there's no real magic clean energy thing here. And I think especially over the last year, the price of batteries and the prospects for various electric vehicles has really changed, whereas natural gas was for a while seen as like, oh, well, this is a better than diesel kind of solution. And I don't know that that story necessarily holds up. The other thing I look at is this chart where, again, this is a stock that was trading at $2, $2.38 less than a year ago, went all the way up to 18 and then came back down. I'm not entirely clear why all of this happened. Like I said, there's probably some electric vehicle mania, et cetera, things like that going on here. And then they recently signed a deal with Amazon, and the stock went up and then came back down. But I looked into the Amazon deal a little bit, and part of the reason the stock started to fall was a downgrade from analysts at Raymond James. What happened was, as part of this deal with Amazon, which Amazon's a big company, don't get me wrong, Amazon's not operating a huge natural gas vehicle fleet though. So there's some economic benefit to the company here, but they also issued warrants to Amazon to buy stock that would account for, roughly 27%. So Amazon can own 27% of this company in exchange for whatever this business is, whatever, the economic interests in this deal are. And so that means that everybody who owns stock in the company now potentially is going to lose 27% of their stake to Amazon. That's probably why the stock started to fall there. All right, and then C3AI support at 59. There's no real magic to finding support. There's a lot of people who make it super complicated, but yeah, I mean, this is the all-time history of this stock right here. And so it looks like it's bounced at around 60 or 60-20 a couple of times. It seems like it's finding some support here. I don't know that there's anything magical about this level. It hasn't really bounced off of it. It's just kind of not gone under it and drifted higher and then gone back down to it. So yeah, I mean, on some level, it seems like it has some support there, but I don't think there's anything particularly strong or magical about it. All right, what is your outlook for real estate, gold, Bitcoin, or computer chips? So real estate is hard to give a broad single answer on, right? It's a big country. There's lots of different uses for real estate. Home demand right now is pretty high, although some urban areas are likely to see some decrease in demand. Like single family home demand is super high. Let's say I think some big apartments and things like that are maybe seeing some decrease in demand, but I generally think the long-term effect on cities is probably overstated. I don't think the pandemic is the end of cities. In fact, I think that there's probably a lot of young people who see rents in places like New York or other cities that might be exciting to live if you're young as cheaper than they've been in a long time and might want to try to move there. The other thing is household formation has been low since the Great Recession. So there's just pin-up housing demand to sort of burn through. And things like stimulus checks and some other stuff can maybe help some people get closer to that down payment than they were before. Commercial real estate, I think, is kind of going to be interesting. I think the idea that offices are over is probably overstated, but I think in the short term, demand for offices is going to be less. Now, how that works out in terms of like, okay, well, we're going to have office space, but we're going to have more square feet per worker. How that shakes out is kind of hard to figure out. Retail is where I think things are going to get really interesting because I think people might continue a lot of delivery of commodities, right? Like if I don't have to make an extra trip just for, toilet paper and Kleenex, I may just, let Amazon keep delivering that once every 2 months or whatever it is. But I also think there are a lot of people who want to go out and do things, which include shopping. So I think the brick and mortar stores that survived could be a good spot, but I think your specialty retail, right? Like when people think about, ooh, I had a fun time going shopping, those are the places that I think have a real good outlook in the short term, whereas I don't think anybody's necessarily excited to go back to the grocery store. So that may, and people have also been buying groceries this whole time. So there's maybe less upside there. I don't have an outlook on gold, right? Like it doesn't do the things that people keep telling me it does. It just, yeah. I just don't. Bitcoin, my outlook is continued volatility. Again, it doesn't do any of the things that people keep telling me it does. Right? It's not money in the sense that if I had some Bitcoins, I would know where to buy a pizza with it, which is, I feel like, a good test for what is money. And so, yeah, I expect the price to bounce around a whole lot, but I don't know. And then computer chips. So interestingly, there's a couple different chip shortages that kind of get all lumped in together. So I think that a crash in the price of Bitcoin could actually relieve some pressure on some of the high-end like graphic processing chips, right? So one of the reasons it's hard to buy a PlayStation right now is a lot of the chips would go into PlayStations also power things like Bitcoin mining equipment. The price of Bitcoin falls, people are probably going to be less hot to buy Bitcoin mining equipment. You could make a few more PlayStations that way. So I think that would probably relieve some pressure there. And then memory and other commoditized components, right? So, computer memory is by and large computer memory. There are some different flavors. You can't just, go buy RAM and shove it in any computer you want. But by and large, at the chip level, it's pretty much a commodity. And I think those things are going to be high for a while as foundries just work to add capacity. It's not easy to set up a new production line, especially of something as specialized and sort of fine as that requires a lot of complicated equipment. I think Micron Technology, which is a big memory maker, said they expect, to have some good pricing power through the end of the year. And maybe beyond that, we'll see. All right, so this is the last pre-submitted question. Jeff asked, in the managed option portfolios, we have diagonal spreads and covered calls. What do we look at in deciding whether to use a diagonal spread or a buy-right strategy? So buy-right, for those of you who don't know, it just means covered call. It means you buy the stock and write a call, which is the same thing you do in a covered call. All right, so we have 3 portfolios with 3 different strategies: covered calls, diagonal spreads, and vertical spreads. And we treat them as 3 portfolios in the sense of sort of 3 different products, right? So this means we look for covered calls, and we look for diagonal spreads, and we look for vertical spreads. And we sort of have a process for each one of those. Okay, so what that also means is we don't find a stock we like and then sort it into a strategy. What happens is we find a trade we like under one of those 3 categories. And yeah, there are some days where some stocks could go in any portfolio on any day. Covered calls, we tend to try to find stocks with prices less than $80 because buying 100 shares of a stock that costs more than $80 can get expensive. Diagonal spreads, we try to keep the debit less than 40 for the same reason. Now this does open the door to some higher price stocks in the diagonal spreads portfolio, but there are still some sort of price-based constraints because of how option pricing works, in the sense that, right, like, you try not to do a diagonal spread where the amount at risk is more than some percentage of the stock price, but something like Amazon, I don't want to put more than a third of the price of the stock into a diagonal spread. Well, hey, that's still a real expensive trade if you're looking at something like Amazon. So there's still some, and then vertical spreads, nothing wider than $5. So that opens up pretty much the full range of stocks. The other thing I will say here is we do try not to put the same stock in different portfolios, because we do know people trade more than we want, and we don't want overexposure in any particular risk. So yeah, that's how our process works. I don't think this actually answers Jeff's question, which is, if I like a stock, how do I decide whether it should be a diagonal spread or a covered call? that's, yeah, I feel like generally a matter of personal preference, and you can compare things like the annualized return and some things like that, but it's largely a matter of personal preference as far as I'm concerned. So that's all the questions people submitted ahead of time. I've been watching this box over here, and there's a whole bunch that came in, so let's see. All right, what is your opinion of the cannabis industry? I think the cannabis industry is getting closer to being a real industry than it has been for a long time. More and more states are legalizing. I think some amount of legalization, or at least decriminalization on the federal level, is likely in the next several years. All of that said, I'm not sure. Yeah, especially with things that are out this week in terms of like the Biden administration considering really lowering the maximum legal amount of nicotine in a cigarette. I'm not sure why somebody like a Philip Morris, that is a giant company with a huge packaging and distribution and marketing arm, or marketing operation, and relationships with thousands of farmers and millions of acres of farmland. I'm not sure what's to stop them from getting into the cannabis industry, which is to say that a lot of the small cannabis stocks that are in the sort of, oh, we grow and sell a plant, can just absolutely get destroyed if the big guys get involved. Right now, the companies that are like, oh, we're growing and selling a plant and then making it into a particular branded product, that's a thing that I feel like is a little bit harder for them to compete with, because, oh, we're making a product, especially some of the biotech stuff, right, where there's like a regulatory compliance process and things like that. That gets a lot harder to compete with. But I'm generally skeptical of buying commodities, and I feel like full legalization and a booming cannabis industry, the actual plant becomes a commodity, at which point all these little guys who are like, ooh, we grow a plant and sell it for a high margin, are just going to get smashed, because once it becomes fully legal and commoditized, there's no high margin. All right, so what is happening with Luminar? So I've seen this stock, but I don't remember exactly what it does. Autonomous vehicle sensor and software company. Yeah, my guess, it doesn't seem like there's any real news here. Yeah, okay. My guess is, and it seems like this is probably right, is that, yeah, it got caught up in the sort of mania around electric and self-driving cars, and went nuts. Okay, so the company's not profitable, doesn't have a PEG ratio. Yeah, that seems like what's happening is probably these prices up here didn't make any sense. The stock is still roughly double where it was in November. So yeah, I think that's probably what's happening. All right, so George says, do I think tech and small cap stocks will rebound to previous highs? I think as categories, yes. Some individual stocks, right? I mean, this is an example. I don't know that this is getting back to $41, $42 anytime soon. That seems crazy to me. That the stock would go from 9 to 40 in 9th of December, less than a month. Right, so yeah, some of the stocks that were at super all-time highs that just had crazy valuations, I don't think those are getting back to those valuations anytime soon. In general, the sort of broad categories, yeah, I think those will probably rebound. Like I said, it's a rotational thing. This is the kind of thing that happens from time to time. All right, do I have an opinion about NVIDIA's ARM acquisition and how much of a risk of regulatory rejection or approval is priced in? I'm staying away from it is my my professional opinion. I think it's interesting. I understand NVIDIA's business case for wanting to acquire ARM. I also understand why a bunch of regulators would maybe not want to let that to happen. And given that it's like needs approval in the US, Britain, China, and maybe some other jurisdictions, my opinion in terms of as an investment is I'm just kind of staying away from it. All right, so Stan says, can I comment on Plug? Plug is an interesting one because this company has been around forever. I mean, this is, March of 2000. So it managed to go public sometime during the dot-com boom and then managed to capture the bust. So it's still well below an all-time high. The thing to note here is the stock never traded at $847. They've issued a lot of stock and probably done some splits since then, or some reverse splits, and that's why you see this crazy chart like this. And so, more recently, I mean, this looks a lot like some of these other stocks we've looked at, right? Where it kind of went nuts in November and December because of just sort of a mania around it. If you've been holding it for more than about 4 months, you're probably doing pretty good. If you bought it in the last couple of months, probably less so. All of these things are so hard to value, and it's so hard to understand what the technology actually is. As a more of a generalist, I don't have a good comment on anyone in particular here. All right, let's see here. Yeah, biotechs are another space that, I mean, this is the same chart, right? I mean, it's not exactly the same chart, but it's close. So I don't have much to say beyond that. Biotech is another one where to really, especially genome analysis, you really need a more of a specialist than me to comment on that sort of thing intelligently. All I can say is, I mean, if you bought it more than 3 months ago, congratulations. If you bought it more recently, I really, have a harder time knowing what to tell you. All right, the last question we'll get here is thoughts on the Coin IPO. So Coin is it's interesting. Okay, so I don't have a lot of things to say about Bitcoin and what the price should be. This is interesting also. So one thing I would say is they didn't actually do an IPO. What they did was a direct listing, which meant that people who own the stock on the private market can now sell it publicly. And what that means is the company didn't see any need to raise any money, and so they didn't. They just said, look, we'll go through this registration process, we'll have an auction on the exchange, the shares will start trading, and you can see it hasn't been great for the people who bought it on the exchange early. The people who were private holders before are probably still doing okay. But Coin is interesting because they make money essentially running an exchange. You can trade Bitcoin and some other cryptocurrencies on their platform. And what's interesting about this to me is, one, the whole promise of Bitcoin is you don't need financial institutions, right? Like, oh, we can get away from the banks and all the other financial institutions, and yet here's a company that managed to get a $62 billion market cap being a financial institution that deals in Bitcoin. So I have some questions about that. And the other thing is, running an exchange there's some peculiarities to doing it in the crypto space in terms of custody and things like that, right? Like keeping dollar accounts is relatively easy, whereas keeping cryptocurrency accounts, there's a bunch of cybersecurity and stuff like that that gets complicated. But the but the business of running an exchange isn't super hard, right? You're running bids and asks against each other, and where they cross, you have a trade. And so if you look at Coinbase and the dollar value of the transactions they do, it's incredibly small compared to, say, one of the stock exchanges or the total volume of Intercontinental Exchange, which owns the NYSE and the NASDAQ. And so it's hard to, I guess my real question is, what happens if somebody else decides they want to run a Bitcoin exchange for 10% less than Coinbase charges per trade? Right now you're in a race to the bottom, essentially, where all that profit margin goes away and you're competing on some other things. And so, as long as no competitors emerge, they seem like they have a good business and they're making money as long as people remain interested in trading Bitcoin. All those things I said earlier about, why do we need Coinbase if we have a fancy technology that gets rid of the financial system are, how to translate that into what the stock price of Coinbase should be, I have no idea how to do that. But I do think the whole thing is very interesting. All right, so that is all the questions I think we have time for. Thank you all for coming. Thank you for subscribing to Investors Observer. If you need to get in touch with us between workshops, our phone number is on the website. You can also use this help button to send us an email, and we will usually get back to you pretty fast. This session was recorded. We will post the recording on the website tomorrow, and send everybody an email to let them know when it is available. Our next workshop will be in 3 weeks, which is somewhere around May the 12th. So, like I said, thank you all for coming. Thank you for subscribing to Investors Observer, and I will talk to you soon.